For years, experts have been predicting calamity in the bond market as inflation finally takes off and bonds get hammered. We're joined today by bond portfolio manager Bill Irving of Fidelity Investments. Bill, you've had a great record throughout all of these years that everyone has been telling everybody to run away from bonds.
Right.
Should we finally be concerned, or is this going to continue?
I think it's going to continue. I think that we're in a low growth world where there are a number of headwinds that are restraining growth and are also going to keep a lid on longer term yields.
The Trump administration is very confident that they can get the economy back to 3 to 4% growth. Yes?
Well, I think that there are things that the administration could do that could be very supportive of growth. Potentially we'll get fiscal stimulus that will improve our roads, improve education, all that. That would increase the productive capacity of the economy and could lead to higher growth. But in the near term, I do think it's going to be a challenge to get 3 or 4% growth. And so all I can say is we're keeping a very close eye on what sort of reform do we get. I do expect that later this year we will get a tax cut, maybe some tax reform. Fiscal stimulus seems to have been put on the back burner for now. I think there's more focus on getting the tax reform and maybe coming back to healthcare reform. But we have to see what the administration brings and what kind of policy change we get.
And some people think that the Fed is being too aggressive, that the economy is very weak. It was weak certainly in the first quarter. They're going to be too aggressive about raising interest rates and they're going to crush growth. Is that your view?
No. I think that we're on track to get a couple more interest rate hikes this year, likely one in June, another in September. I think the Fed is the most confident they have been since the financial crisis that the economy can handle higher rates. The Fed's confident. And I think what they want to do is at least get back interest rates so they're neither stimulative to the economy or restraining to the economy. And I think to do that requires at least a couple of more interest rate hikes.
So you think the outlook for a diversified bond portfolio over the next 3 to 5 years is the same as it has been, 3 to 5% a year?
So no, I would say that there's going to be upward pressure on the front of the yield curve as the Federal Reserve continues to raise interest rates. Longer term yields are going to continue to be held down by these forces that we were talking about earlier, these structural forces that are going to limit growth and therefore as a corollary keep a lid on bond yields. And so I think a diversified bond portfolio can still return low to mid single digit returns.
And you mentioned the flattening of the yield curve. Should we be concerned that that is a harbinger of a recession as it has been occasionally in the past?
I don't see a recession imminent. I think we're going to continue to see 2% growth. Yes, the first quarter GDP was a disappointment, but keep in mind in 4 of the last 5 years, quarter one GDP has been less than 1%. I think that the outlook for the subsequent quarters is going to be much higher. Maybe we get 3.5% growth in the second quarter, so that it'll even out and get us back in the long run to this 2% growth. The wild card is what happens when the Fed starts to let their balance sheet unwind. We know they have a $4.5 trillion balance sheet. They've expressed their intention starting next year to let that balance sheet run off. As those excess reserves are drained from the system, what's going to be the reaction in the mortgage-backed securities market, corporate bond market, to equity prices? Keep in mind, risk assets did very well as the Fed grew its balance sheet. As it shrinks it, do we get a reversal in some of that?
Bill, thank you very much. Great to have you.
Thanks for having me.